Welcome to Personal Finance 101 at MrWebProfessor.com. This is lesson 1, and we're going to talk about your personal financial checkup. So let's dig right in and look at the agenda. Some of the things we're going to cover in this particular lesson, which is only one portion of an entire course, is understanding the mistakes that we all make but we can avoid. We're going to also learn how to determine our financial position. And a piece of that is understanding the basics of our credit scores, our debt and savings ratio. We're also going to talk a little bit about asset protection as well. So let's get started. What are some of the common mistakes that people make with their finances all the time? Well, perhaps one of the biggest is talking to their neighbor Bob, who tells them to make a stupid financial decision based on no knowledge of the financial world whatsoever. So really, when you take poor advice from a non-expert, you're just setting yourself up for failure. Another big mistake that people make is not having enough protection from catastrophic risk. So they build their investments, they build their financial plan, but they forget to have contingencies in the plan to protect them against some major risks that may completely implode that plan. Also, not looking around for the best deal, not doing smart shopping. I'm not just talking about grocery shopping, I'm talking about on large purchases as well, such as purchasing a car. You really want to make sure that you're looking for the best deal when it comes to everything that you purchase. You got to look out for those non-professional salespeople. They're out there. People who call themselves financial professionals but don't have the education to back it, or don't have the experience to back it. So make sure you understand the background of the person you're working with. Overusing personal lines of credit. This is just not good for your overall net worth, which we're going to define for you a little bit later on. Overspending and failure to develop a clear financial plan. Without a plan, you don't know where you're going, you may not even know where you are. It's so important to develop a clear financial plan so that you can reach your financial objectives, because your finances touch every part of your life and we cannot escape that. So having a plan will also help you to develop a plan for your life. So how do we determine our financial position? Well, it's very important to know where you are. If you don't know where you are, you don't know. You can't reach your destination. If I am in Oregon, but I think I'm in California, it's going to be two completely different paths between Oregon and California to get to New York, if that's where I want to go. So knowing your starting point, your point of origin, is so important. It's important so that you can plan for the future, so that you can ensure that you're going to get from Oregon to New York if you're in Oregon, or if you're in California, to be able to get from California to New York. It's extremely important to know where you are so that you can plan to get to where you want to go. It's important for your family, and it's important for you. Somebody once said that once you know where you are, it's the starting point to anywhere in the world you want to go. So how do you determine your financial position? Well, there's a simple formula. It's assets minus liabilities equals net worth. So what are assets? Well, we're going to talk a little bit about that now. Your assets are things like cash that you have on hand or in the bank, investments such as mutual funds, stocks, bonds, and other things like your business, your overall value of your business if you own one, or real estate, whether it's your own home or other real estate investments that you may have. That brings us to the question, once we know what all our liabilities are, once we know what all of our assets are, what are our liabilities? Well, those are all the loans, auto loans, your mortgage, things that you owe people for, your credit card debt, lines of credit, loans from friends and family. Anytime you owe money, it's a liability. So to determine your financial position, or your net worth, you take all of your assets and you add them all up. You write that number down. Then you take all of your liabilities, you add those up, and you write that number down. Then you subtract your liabilities from your assets, and this will give you your financial position or your net worth. And you can stop here, because if you're viewing this on MrWebProfessor.com, underneath this video there are some great links to a net worth exercise. Do that exercise and we'll determine what your net worth is for you. Make it very simple for you. So just push pause and go ahead and do that net worth exercise. Now that you've finished that exercise, let's look at determining your financial position from a couple of other perspectives. But before we move on to that, let's understand the results of your net worth exercise. If the number was negative, it simply means you owe more than you own. If the number is positive, it means that you own more than you owe. Either way, it's good news, because now you know where you are, and that means that's the starting point to wherever you want to go in your financial future. And you can make it better. If it's a negative number, we can turn it positive. So together, as you take this class with me, you can develop a financial plan that will help you get on a track to financial health. Let's talk a little bit about credit scores now. When it comes to credit scores, the higher the score that is, the better it is for you. And these scores are based on a number of things, but primarily it's based on your account balances, payment history, whether you've had bankruptcies in the past, and delinquency rates. It's also important to look at your credit report just to make sure that you're aware of everything that's on it. And you can get your credit report for free once a year at annualcreditreport.com. You just go to annualcreditreport.com and fill out the forms, and you can get your credit report instantly over the internet. Now, these reports come from Equifax, Experian, and TransUnion. Your credit score is not listed on the report, but for a little extra money, which I highly recommend doing, you can at all afford it, is to go ahead and get your credit score. Again, the higher your credit score is, the better off you'll be. Let's talk a little bit about debt and savings. What is bad debt? Well, bad debt is something that's not backed by an asset. So for instance, your mortgage is good debt because you own the home and you have a mortgage on it. And so if you sold the home is the asset that backs the mortgage, and hopefully you'd be able to, at a minimum, break even, if not make money. Bad debt, on the other hand, are things like credit cards, where there's really no one asset that backs the money due to the credit card company. And generally speaking, consumer goods cannot be sold to recoup the costs and pay back that debt. Personal lines of credit are another source of bad debt. So if any time you take a loan from a friend, that's bad debt because you don't have an asset to back it. So you just consider if there's an asset that you can sell to recoup some of the money, then it's probably good debt, generally speaking. If there isn't an asset that you can sell and recoup all of the money that you owe on that credit card or the personal line of credit, then it's probably bad debt. So analyzing your bad debt, what's the formula? We'll take all of your bad debt, all of your credit cards, personal lines of credit, all of that, add it up, and then divide it by your annual income. This will give you what I call a bad debt ratio. Understanding that ratio, well, if it's more than a 20% ratio, or 0.2, you may be in trouble and you want to act quickly, because this means that you have over 20% of your annual income. If you took 1/5 of the year that you worked and you gave it to all of that bad debt, that's what it would take to pay it off. That's not even including the interest that would be accruing. So you want to act quickly if it's 20% or more. The best, of course, is zero. Having no bad debt whatsoever, being completely debt-free, is the best position to be in terms of debt. Now, what about your savings? Well, you can also do the same measurement using your savings. Take all the money that you have in your savings accounts, add that up, divide it by your annual income, and this will provide for you a savings ratio. You want to have about 5% of your annual income in savings, and so if the ratio is less than 0.05, then you want to consider improving that. 0.05 would be 5%. Let's talk a little bit about investments, just generally here. We get into this a little bit more later on in the course, but for this lesson I just wanted to touch on a few key points about investments. One, they should be making you money. You should have some of those that are available to you that can be tapped in an emergency, that are immediately available to you. You don't want to have things, all of your money's tied up in a particular investment that you cannot recoup, such as a real estate investment where you have to sell it off in order to recoup that money. You want to have them in at least a portion of your investments in accounts that can be liquidated quickly. You want to know your income tax bracket so that you can anticipate how you're going to be taxed on those investments. And make sure you understand how each investment's going to make you money. The company or the mutual fund that you're invested in, understand what that is and how it works. Now, briefly, we're going to talk about asset protection. You're going to want to have certain contingencies in place for your financial plan, such as auto insurance, homeowners insurance, life insurance, long-term care, disability, critical illness. Now, not all of these are necessary for each individual, but having a contingency and understanding how these catastrophes can impact you and your family, and planning for the possibility of those events taking place, and protecting you and your family from the losses that could happen. It's important to consider having contingencies in place in the event that something should happen to you or one of your loved ones. So let's talk about some good indicators of financial health. Positive net worth, a high credit score, high savings ratio, and a low bad debt ratio. Those are all indicators of good financial health. Indicators of poor financial health then would be just the opposite. A negative net worth, low credit score, 500 or less, low savings ratio, and a high bad debt ratio. If you have all of those indicators, you really need to put together a plan to help you to get more towards the good financial health indicators. So let's quickly review. We discussed understanding the mistakes that we all probably have made but could avoid. We learned how to determine our financial position, and we should have a good understanding of what it is now. And we learned the basics of credit scores. We learned how to determine our bad debt and savings ratios, as well as a little bit about asset protection. Now, under this video, there's also links to the debt ratio and saving ratio exercises. Go ahead and do those exercises, do the math, and make sure that you understand your results, because this lesson is about you discovering where you are so that you know what you need to do to get where you want to go. Once again, if you're viewing this on Google or YouTube, please visit us at MrWebProfessor.com for the entire course.